Investing can be tricky, but knowing what to look out for, you'll be well on your way to financial success. We're going to be discussing the top 5 mistakes to avoid when investing. But before we start, remember to hit the like button and subscribe to our channel so that you get more investing tips and strategies. Top 5 investing mistakes to avoid. Number 1, not having a plan. The first mistake you want to avoid is not having a plan. Investing without a plan is like trying to navigate a ship without a compass, or like trying to cook a 5-star dinner without a recipe. It's just bound to end in disaster. It's important to have a clear idea of what you want to achieve and how you're going to get there. This includes setting clear financial goals such as retirement savings, college funds, buying a dream yacht, etc. Once you have set your goal, you need to develop a strategy to achieve them. This strategy should include the types of investments you'll make, how much you'll invest, and how often you'll invest, and your expected returns. It is also important to have a risk management plan in place. Risk management involves identifying, assessing, and prioritizing risks to your investment portfolio and implementing a plan to mitigate or prevent them. This will help you to be prepared for any market fluctuations so that you don't make impulsive decisions based on fear or greed. By having a plan, you'll be better equipped to make informed investment decisions, stay focused on your long-term goals, and have a clear understanding of your risk tolerance, and be on your way to financial freedom or buying that dream yacht. Number 2, not diversifying. Diversification is one of the most important concepts in investing, and not diversifying is like putting all your money into one stock and hoping for the best, or going to an all-you-can-eat buffet and only eating one kind of food. It's a waste of potential. Diversification means spreading your money across different types of investments, such as stocks, bonds, and real estate. This helps reduce the risk because if one investment goes down, it's not going to have a major impact on your overall portfolio. When you diversify, you want to invest in different asset classes, sectors, and even different geographic regions. This can help balance out the overall risk of your portfolio and reduce the impact of any one investment on your overall returns. Also, diversifying your portfolio can help optimize your returns by taking advantage of different market conditions. For an example, bonds tend to perform well during economic downturns, while stocks tend to do better during periods of economic growth. By diversifying, you can take advantage of these different conditions and potentially earn higher returns over time. Like buying a ticket to a variety show, you get to enjoy different performances and increase your chances of having a good time. And let's not forget, diversifying can be fun. It's like having different kinds of ice cream in the same cone. You get to enjoy different flavors, and you're not stuck with just one. Number 3, chasing hot investments. The third mistake is chasing hot investments. Every once in a while, an investment will suddenly become very popular and gain a lot of attention in the media. It's easy to get caught up in the hype and think you're missing out on an opportunity, but this is often a sign that the investment is overvalued and due for a correction. It's like buying a stock at the peak and you're just riding on the hype, and it's most likely going to come crashing down. Instead of chasing the hot investment, it's important to focus on the fundamentals and long-term trends. This means doing your own research and understand the underlying business or asset behind the investment. Look at factors like financials, management, and industry trends to get a sense of whether this investment is truly undervalued or overvalued. You also want to be careful of investments that promise high returns with little or no risk. These type of investments are often too good to be true and can lead to significant losses. Instead, focus on investments that offer a reasonable balance of risk and return. Chasing hot investments is like buying a pair of trendy shoes just because everyone else is, only to realize they're uncomfortable and they fall apart quickly. Stick to what you know, understand, and feel comfortable with. That's a recipe for successful long-term investments. Number 4, timing the market. Timing the market is another common mistake that investors make. It's the act of trying to predict the exact timing of the market movements in order to buy or sell at the optimal times. The problem is that it's impossible to predict the market with any certainty, and trying to do so can lead to costly mistakes. Similar to trying to predict the weather, some days you just can't win. It's important to remember that the stock market is inherently volatile, and short-term fluctuations are normal. Instead of trying to time the market, it's better to focus on buying quality investments at reasonable prices and holding them for the long term. This is known as dollar cost averaging, which means investing a fixed amount of money at regular intervals, regardless of the price of the investment. This helps minimize the impact of short-term market movements and allows you to take advantage of the long-term growth potential of your investment. Another important point to consider is that trying to time the market can lead to missed opportunities. It's impossible to time the market perfectly, and even if you do, it is impossible to predict when the market is going to change directions. By trying to time the market, you risk missing out on potential gains and limiting your overall returns. It's better to focus on building a well-diversified portfolio and holding it for the long term. Number 5, ignoring fees. Another common mistake that investors make is ignoring the fees associated with their investments. These fees can include investment management fees, trading fees, and expense ratios. It's important to pay attention to these fees because they can eat into your returns over time, like a slow leak in a tire. You don't notice it at first, but eventually it will make a significant impact. Investment management fees are the fees charged by the company or individual managing your investment portfolio. These fees can range from a few basis points to several percentage points, depending on the type of investment and the manager. Trading fees are the fees that you pay every time you buy or sell a security. These fees can vary depending on the broker or platform you use, and they can add up quickly if you're making frequent trades. Expense ratios are the fees that are charged by mutual funds and exchange-traded funds, ETFs, to cover the cost of managing the fund. These funds are typically expressed as a percentage of the fund's asset and are charged annually. While these fees are an inevitable part of investing, it's important to be mindful of the fees you're paying and to compare different options to ensure that you're getting the best value for your money. It's also worth noting that some of the most successful investors are the ones that keep their expenses low in order to maximize their returns. Remember, investing is a long-term game, and it's important to have a plan, diversify, and be mindful in fees and taxes, and stay within your risk tolerance. By avoiding these common mistakes, you'll be better equipped to achieve your financial goals and build a solid investment portfolio. Remember, the most successful investors are the ones that keep it simple and stay disciplined. Thank you for tuning in and happy investing. Don't forget to hit the like button and subscribe to the channel for more great content like this. If you have any topics and you want to learn about more, leave a comment down below and let us know. We'll do our best to cover them in the future.